All right. Good morning, good afternoon, and good evening. It's Thursday, April 6th, 6:02 p.m. A day ahead of our co-host's birthday, special day. Wowie. Advance happy birthday, Wowie.
Thank you, Mark. I'm turning 53 tomorrow.
Wow.
Thank the
And
Lord.
and more years, more fulfilling and successful years onwards.
Thank you. Looking forward to it.
Yes. So we welcome you guys to our latest episode, episode 73. Warning signs. So, just for the record, we are not any registered financial planner, but me and Wawi are physical therapists here in Texas, and we focus on investing our hard earned money in the stock market. For those who are tuning in, if you stay put throughout this episode, maybe probably 20 or 30-minute long, we'll be sharing very special information or charts that we have researched in the past couple weeks that may entail or signify or indicate what's to come in the stock market. But currently, we're both invested, and hopefully it turns out for the best. So off we go. We usually look at weekly sentiments. So according to the Seeking Alpha article, AAII, or American Association of Individual Investors sentiment, if people or investors are bullish or bearish. Bullish means they think the stock market will go up, bearish goes down, or neutral in the coming weeks. They said that the pessimism or negative thoughts about the stock market has maintained above average for the 7th consecutive week. So if we're going to look at the data as of yesterday, bullish investors, so not so much, they are at 33%. Meanwhile, bearish investors are at 35. So even though that the pessimism has been ongoing for the past nearly couple of months, bearish investors have retreated almost from the usual 45 and above average for the past month. They are at 35%. So a little less pessimistic, as one might say. And there are more bullish investors thinking that the stock market would go up, which is interesting. On the fear and greed sentiment index, we are seeing greed for this week, whereas a week ago we were at fear. So quite a rally in terms of being optimistic in the stock market. What do you think, Wawi? Just in the past 5 days.
Yeah, the past 5 days have been good. Um, well, we just had a little bit of rally this past 2 days.
Hmm.
So, so that's rather unusual because there's a lot of recession fears. You
Right.
know, the yield curve is still inverted,
Hmm. I think
but
it's the most inverted in its history.
yes, yes. So we're kind of in a dangerous state right now.
Hmm.
But I'm still, I don't know. I'm the diehard optimist here, still the contrarian. Still, maybe it's just a hopeful thing for me to think that it will be a soft landing. We'll
Right.
find out.
And going back to the yield curve inversion that you have mentioned, usually we see a recession 12 to 18 months after it's expected or it's been observed. So ever as we go deep in the yield curve inversion, so who knows? Earlier this year they were saying that it would be happening in the second quarter, and now is the start of the second quarter this month, April. So as one would have followed or who has been following the market, we actually had a good first quarter for the S&P 500, especially for the Nasdaq, the
Mhm.
tech-heavy sector, which we're gonna see in a little bit. It's been a very fruitful 3 months, first 3 months of this year, despite the turmoil in the banking industry, especially of the collapse of two banks, Signature and what's the other one? Silicon Valley Bank.
Mhm. Well, somebody I was talking to earlier wanted me to look at the charts from before the pandemic and look at the, you know, the the chart. of the S&P 500 pre-pandemic up to
Mhm.
now, and looking at the, you know, the peak of that chart, you know, from 2019 to, you know, the little downtrend that we're seeing right now.
Mhm.
Um, so what she's saying is she sees that this is really not not normal. Uh, so a lot of people are expecting recession. Bottom line, you know, that's what she's seeing,
Right.
that the recession is about to happen,
Yeah.
and all these signals. She's a technical person, so she sees the, you know, the signals of a recession oncoming, not just for the short term. It may take a long time for the recession to ease, is
Right.
what she's saying.
Well, we'll see. We are up about 67% since at least 2019, or the low of December of
Mhm.
2018. So that's quite a ways up. Regardless, the market momentum. So this is what we also take a look at on a short-term basis. 125 days, or as good as 4 months average. So the market, the S&P 500, has remained higher compared to that level. So usually we take note of it whenever it reaches that average. So we're quite a ways from that. Um, so we haven't topped the previous high and back in the recent high in February 15. But
Mhm.
if anything, we might reach it if the momentum still goes up, regardless of the ongoing uh, you know, fear of recession and stuff. Um,
So hopefully it's a consolidation, but we'll see the trend here in a few weeks.
right. And we're gonna give this a shot, this Yahoo Finance chart. This is a comparison with the volatility index, because right now we are at 18, which is a little low, right? Well, and usually we typically
Mm-hmm.
see volatility somewhere in the 20s,
Mm-hmm.
but for the past week alone, it's down 2.85%. For the past month, it's down 6%. Regardless, for the past 6 months, it's actually down 41%. So it's been trending down quite a bit. And usually, volatility is a good gauge when you actually want to go in the market. If, timing is not really a good way of investing if you're in for the long run, but it kind of serves as a guide. So on our screen right here, if you're tuned into our YouTube channel, we are seeing the volatility. We're just going to focus on the times when it is on the down low and put a vertical line in comparison to the S&P 500. So the blue line is the volatility, S&P 500 is the red ink. So back in 2020, March, you can clearly see that let's make the color yellow, I guess. I think it'll be better. Something like, yeah, there you go. March 9, 20, or roughly around that time, March 9, 2020, the volatility spiked
Mm-hmm.
200% on one day. And that's when the S&P 500 bottomed. So let's see now when the volatility is actually down. Sorry, we're going to stick with that. So if volatility is down, what happens afterwards? So we got one on May or April 12 of 2021, June 28, 2021, over. And we actually haven't seen that much of a low of a percentage recently. But we have one down here.
Mm-hmm.
We have one down here recently, 2022. We have one down here, November, and a couple more. So a lot of lines actually. So we're just gonna try to focus on the ones that's from March of last year. and what happened afterwards. So March of 2022, we see a dip in volatility, and that kind of indicated a top, a short-term top on the S&P 500. It went down quite a bit after that, all the way to June of 2022. And then back in August of that year, we saw quite a dip in volatility, and that kind of indicated a top again for the S&P 500, which led down the S&P 500 starting August to October of that year. And then November, we see a dip again on the volatility, and it affected the S&P 500 again. It went down, not quite, but it then bounced back up here, back in January. So could
Mm-hmm.
be just seasonal, but on the three occasions, 2 out of 3 at least indicated quite a good signal that the S&P 500 was at peak. And right now, at this point of time, we're actually in the same kind of percentage level compared to last year of August and November when the S&P 500 started going down. So what does this indicate is that volatility, although it's been quiet since the start of the year, we might see it's about to we're just playing fortune tellers here. It might go
Mm-hmm.
back up again and then hit
Yes.
the overall stock market. So we're not
Yeah.
saying this 100% for sure, but what do you think, Wawi? Yeah, it could affect S&P 500.
And that's exactly what we were talking about earlier, is the increasing choppiness of that chart.
Mhm.
So expect more choppiness, higher frequency of that choppiness on the VIX, affecting the S&P 500. And when it comes to recession, you never, according to the Motley Fool, you never know. The highest indicator of a recession is when the Enver says it is. That's
Mhm.
when you know the bottom is when the Enver says it is. And then the ISM new order index.
Mhm.
Right now we're still at 43 on the new order index, so we haven't reached 42. But once it reaches 42, then we need to start thinking.
Yeah.
That's
Anything
a good
less,
signal.
I think anything less than 50 indicates contraction. So
Mm-hmm.
although I think we recorded, so you're referring to the ISM service, right?
Mm-hmm. The new order index.
Oh,
So
okay.
anyway, yeah, if it goes below 50, we're contracting on those manufacturing orders. But let me correct myself. We are at 44.3.
Oh, we
Um,
are.
so if it goes down to 42, definitely a signal for recession, that we probably hit bottom there.
Mhm. So right now we are looking at the weekly performance of different sectors in the stock market. For the past week, the best performing are the communication services, followed by healthcare, followed by utilities and energy. Meanwhile, the
Mm-hmm.
worst performers are industrial, consumer cyclical, and basic materials. Technology is lagging behind. But what's interesting, Huawei, is communication services is actually being led by Google, so
Mm-hmm.
and Facebook. So despite that, they're quite a ways from technology sector as a whole,
Mm-hmm.
but the communication services is definitely way up, the best performing sector in the week. I think this is all because of the AI talk. I saw an article just this afternoon that Google is trying to now incorporate its AI into the Google search. So quite following
Mm-hmm.
behind Microsoft's Bing now. But I think that's why we have felt some appreciation in Google's stock price in past week. If we're going to take a look,
Mm-hmm.
today alone, it's up 3.7%. and for the past 5 days, it's actually been trending up 7%, and it's
Yeah,
up
there's
20.
a lot of talk about
Mhm.
there's a lot of talk about AI right now, and these large cap companies, communication sector technology companies, including Microsoft. Just read that Microsoft is also uh, gonna compete with Apple Siri using
Mhm.
the AI. So it's a lot of buzz about AI right now. It's
Yep.
pushing some of these stocks up.
It's the trending topic in Wall Street. Well, I think
Hmm.
despite that, C3 AI, I saw its stock plummeting the other day. Uh,
Yeah,
I think it didn't
because
meet expectations.
well, a short seller is saying that the books are not right.
Oh,
So,
right. So that's another whole new whole new deal there. There's
hmm.
money, big money behind that, betting that the stock market would the stock price of its company would collapse. So it actually is down 17% for the past 5 days.
So
So
you can see the influence of the news.
mhm,
When you hear news like that, people get scared and they pull back.
right, scares some money away, resulting
Hmm.
in drop in price. So this is a Bloomberg article that was just published this afternoon saying money fund assets hit new record high. A lot of money plowing into money market funds. Total assets reach unprecedented $5.25 trillion. The pace of weekly inflow into money funds slows to 49 billion. So a lot of money piling into the money market since the start of the year. This is like a rocket ship right here. This is not a crypto stock or whatever, or crypto coin, but it is money market. So what's good about this, Huawei, in my opinion, is it doesn't bake in any risk, honestly, because
Hmm.
money market, it's like, you put there's not even a value to it. If you buy a money market fund from Vanguard, it will just put there a minimum investment of $3,000 for a par of value, which is $1. So, but that dollar never increased. It never goes up $1.25, $1.50. It doesn't decrease less than one because for one, it's like for the sake of just giving value, you just park your money there and earn
Hmm.
interest. So what's the deal about this is money market is now generating 4.8%. Well, for Vanguard products, VMFF, I think that's the ticker. And
Hmm.
that investors are realizing that there's more returns from the safe product compared to when they just park their money in the savings account. So my
Hmm.
question is, are you transferring some money to money markets as well, Wawi?
No, not right now. I just um, my cash reserves are still in my savings and my checking account, and I'm still fully invested. I've been thinking about putting some in CDs,
Certificate of
because
deposits.
some of the short-term CDs are at 5%,
Right.
unheard of until now.
Yeah, I think it's pretty much a safe investment. Um, it's a certificate for once. Its name is certificate, so
Hmm.
might be a less risk averse option there. So this is a Reuters report published March 31st. This was about 6 days ago. Investors rack up US money market funds for a third straight week. So this kind of like supports today's article by Bloomberg that a lot of investors are plowing their money in a US money market fund. So 59 billion worth of inflows coming in, and they have received about 270 billion worth of inflows for the month of March, this last month.
Hmm.
They were investors, meanwhile, were net sellers of US stocks, and they have exited large, small, and mid cap funds. So looks like still some sort of adjustments among the sectors. Financials, industrials, consumer staples saw withdrawals of 900, 600, and 500 million respectively. Although tech received 926 million worth of inflows after witnessing outflows for 6 weeks in a row. So
Mhm,
some people loving the tech sector
mhm.
despite
They're
investors.
buying some bargains. They're seeing that the prices are low and they're buying into it.
Right. Well, and then investors turn net sellers of US bond funds. They sold high yield, short, intermediate investment grade funds. Government funds drew 4.08 billion, marking a 7 weekly inflow. So a lot of investors are trusting or entrusting their money to the government, which is
Mhm,
supposedly the safest investment vehicle out there.
mhm,
Although there's one thing that's coming up on June, the debt ceiling. So if Republicans and Democrats don't agree, it could
mhm.
shake some confidence in the government and can start making a lot of panic selling again in the
Yes. So
government.
expect some shakiness come mid-year
Hmm.
when we
Summer,
start. Yeah, come summer when we start talking about the debt ceiling. It'll be shakier then.
right. So this is another article. We're just monitoring where the money is going at this point in time. So this was just published 6 hours ago. US dividend funds see biggest outflows in 2.5 years. A lot of investors are selling their investments in US dividend ETFs. So it means that investors doesn't see the investment dividend funds as a good place to park their money. It's because I think S&P 500 right now is giving you how much of a yield? 1.64. That's so cheap compared
Mhm,
to a money market, 4.8%. So it says here, oh, okay, here we go. We see a quote here from Wealth Enhancement Group, Senior Portfolio Manager Ayako Yoshioka. The yields on money market funds became much more attractive after investors received their December 2022 statement in January of this year and saw that even their dividend paying stocks were down quite a bit, while money market funds at that point were seeing yields near 4+%. So as we have been mentioning along, meanwhile, looks like a lot of investors are realizing their money doesn't earn any much more in S&P 500 dividend funds as well as savings.
mhm,
So even the 3 month, you look at this, Huawei, 3 month US Treasury bill, 5.061%. That's a lot of yield at this point in time.
mhm,
So in the first quarter, iShares by BlackRock core dividend saw an outflow of 1.77 billion. Vanguard dividend appreciation, um, and TD Toronto Dominion US blue chip witnessed 1 billion and 645 million outflows, respectively. So that's quite a big difference. So we're gonna take a look at quickly at the CNBC bond rates. So yeah, 4 month Treasury bill 4.9%, 3 month 4.8%. I mean, you can't beat that if you're just
mhm.
looking uh for passive investment.
Yeah.
So what do you think, Wally? Have I convinced you to start pulling your money out of and put it in money market
Well,
for safety since recession talk has been ongoing?
um, well, that was my plan. But I gave in to temptation and I started, buying into the price. So, um, but I'm still somewhat held back by the news
Mhm.
and by the trend. Um, so yeah, I'm still putting a lot of money into my portfolios, and um, I had a lot of dry powder there for a while, and then I started buying when things were going lower.
Right.
And so far so good. Still seeing a lot of bargains out there. Amazon, Google. Uh, so it was very tempting for me. So I started buying. So anyway, you're not supposed to time the market anyway, but there's a lot of signals that are showing some improvement that gave me some courage to start buying again.
Mhm.
Especially the jobs report is showing some slowdown there. You know, uh,
Mhm.
there's some slowdown in hiring. I think about 96 of the uh, cities the that's on the data. So there's some slowdown. So I'm just banking on the Fed pausing, and that should give us some relief here in May. But then come the debt ceiling, there's gonna be volatility again.
Right. I myself, I'm kind of started nibbling a little bit of money market, started pulling a little bit away, realizing some losses on my poorly selected investments, and it's not a big part of my portfolio, but definitely I have a little bit of money market exposure. So now we have some FANG updates from Yardeni. So this is the FANG composition of information technology. So Apple and Microsoft alone represents 53%
Woo!
of the information and technology sector. So if these two
That's
go up,
huge.
they'll just pull the entire index along. If they go down, good luck. It'll just the whole index will probably be on the red. Alphabet, Meta or Facebook, and Netflix, these three now comprises 44.5% of the communication services. So that kind of explains why. So, technology is way down there for the past week, but communication services is way up because of all that AI talk, because of those two,
Mhm,
uh, Google and Facebook.
mhm.
So, same as how they go about the communication services sector compared to Apple and Microsoft and the IT side of things. Amazon is nearly a third, 30% of consumer discretionary. So it has a big influence. All right. Profit margin update. This is as of end of, let's see, March 31st, as of end of last month, which is about 6 days ago. So forward profitability, we're seeing the most profitable among the FANG group, still Microsoft, 34.7% profit margin forward, followed by the green, which is Apple, 25.5, followed by Google, 22.7. So those are the top three most profitable companies. Microsoft, Apple, and Google. Next, Facebook. Look at that increase in profitability by Facebook since it announced its layoffs late last
Mhm.
year. It jumped about maybe 5 percentage points just by announcing layoff. Netflix is steadily increasing. And down at the bottom, nothing new. Amazon.
Amazon. Well,
Yep.
Amazon has been laying off people too, so might
I
see an
know.
uptick there with Amazon.
Yeah, they haven't shown any actually, even as of late. So that's quite interesting. I think Amazon business is not as resilient or not as profitable now that Amazon Web Services are experiencing competitors left and right.
Mhm.
So forward price to earnings. So things are getting more expensive again since the start of the year. No wonder we are now up how much? 19% for the technology sector. Forward price to earnings is somewhere around 26 times compared to close to 21 beginning of the year. So getting a little bit pricey now for the sector. On we go to our next part. So, the watch tool for the next month's meeting. This is just good to know what the experts are weighing. So experts, more than half, 55.5% of the experts are saying that there's now going to be not going to be an increase. Meanwhile, 44.5 thinks that there's going to be another 25 basis points hike.
Yeah, I'm betting on a pause. That number may increase on a pause. We'll see.
Right. It's soon to be determined. So this is an article that was just published a couple of hours ago in Wall Street Journal. Stocks haven't looked this unattractive since 2007. So basically, what the article is referring to is the S&P 500 equity risk premium. If this goes up, that's the time to buy. So this is another interesting chart that me and Huawei would be looking at. Actually, it's hard to pull this chart, but we have a separate indicator in BlackRock website that would indicate such. So whenever the equity risk premium is up, it's actually a good time to buy the stock. But when it's down or compared to its history, it's really not a good idea. So we've been actually on the down on the bottom of this equity risk premium for the last year or so. It just means that the risk being provided by the S&P 500, it's not worthwhile buying into it because of in comparison to other risk assets out there like bonds, the aggregate bond index, in comparison. So according to this article, this is a quote from Tony Despirito, BlackRock's chief investment officer of US fundamental equities. Bonds are offering a once in a generation opportunity, but not once in a lifetime. So despite this, he's not really pushing for people to buy bonds right now, but it would have been a good time to start probably recognizing that it's actually not a good time to buy stocks at this point. So this is again in running in contrary of our investment thesis where we try not to time the market. But regardless, this is the BlackRock that I was referring to. This they provide at least free to retail investors. So at this point of time, US equities or stock, you could tell it's more on the expensive side when it comes to their equity risk premium. So this is their market risk monitor. Let me see. Well, I apologize. I don't think this is a reliable data. Yeah, okay. Forget about that. We have to find a better equity risk premium chart because this is a late data. Oh, Yardeni has one. Perfect.
Oh, there you go.
So he just updated this yesterday. Let's just go ahead on looking at this quickly.
Right there.
Where's the earnings? Okay, I think that's it. Equity risk premium. Earnings yield and real bond yield. So expected earnings to price ratio. So all the while, Wall Street Journal is pointing an attractive point of time to invest. Regarding Yardeni's chart here, I guess it's actually, you're going to look at 2007 and 2020. It's hard to determine actually whether
Looks like they got the risk premium at 4.5%.
Yeah, 4.5%, but still, it's really not much pronounced whether it's indicating a buy or sell signal. But 10-year
Yeah,
T.
let's see what a good range is.
S&P Global has an index as well. Oh, here we go. Equity risk premium by S&P Global. Oh, it's quite choppy. So you could definitely tell back in March 23, it was all the way down. This was when the market bottomed back then at 70 points. But right now we are at 167 points. So it doesn't even give us that
Oh.
worthwhile of a fear kind of situation. But
Well,
regardless, you know,
well, the average 10-year inflation adjusted risk-free yield of about 1.7%, I think
mhm,
is what they considered, normal. So we're above that.
definitely. Yep, it's quite a risky proposition, but I don't know, Wawi. We'll just rely on
They,
the old classic market volatility.
they're saying that, the economists are saying, this is another thing I find, 3% to 3.5% for 1 year horizon,
Right,
and 5% to 5.5% for a 30-year horizon
right.
is what
Well,
what we should be looking at.
I guess Wawi, we have to cut things short, and that does it for now for our week's episode. And if you guys
We learned
wanna,
something new.
yep, we're gonna take a look back on this one. You guys have a good weekend ahead, and advance happy birthday to you, Wawi.
Thank you and happy Easter, everyone. Subscribe and like.